Well, welcome to my 2024 Q3 market review, a pivotal moment where Wall Street has taken us on a thrilling ride. This quarter has been anything but ordinary, from record-breaking highs of the S&P to the tumble of the tech sector. Your presence here underscores the importance of this review in shaping your investment strategies. Today, we'll dive into how these shifts impact your investments and share actionable strategies to help you navigate this unpredictable terrain. These strategies are not just theoretical concepts, but practical tools that you can use to make informed investment decisions. If the markets have left you with questions, rest assured, you're in the right place. Here is a quick roadmap of where we'll be going during today's presentation. We'll do a quick review of Q3, how the economy and the markets fared this last quarter, 4 key investment ideas for Q4 in 24, 6 evergreen investment principles, a quick review for when markets turn volatile. Here are the 4 key themes to keep in mind during today's presentation. Markets are defying as the tech sector stumbles and global uncertainties, and the S&P still robust gains. Fed rate cuts fuel bond optimism and driving positive returns. Higher rates reinforce the essential role of valuation in investment decisions. Finally, historical data suggests the minimal impact of the presidential party on market performance, challenging election-based investment fears. So far this year, the S&P 500 is up almost 21% for the year, the NASDAQ just shy of 20%, and the Dow's up 13.5%. The broad indices ticked higher, with the NASDAQ remaining mostly flat amid volatility in the Magnificent Seven and AI-focused stocks. The Magnificent Seven has largely lagged this quarter, with investors becoming fatigued all around AI growth. Market rally broadened significantly as investors felt the economy looked healthy enough for stocks from a variety of industries to continue to run, totally contributing to a more substantial rally throughout the remainder of the year. Let's face it, investors are growing wary of tech companies pouring significant investments into AI, which had been significantly outperforming the broader market in the first half of the year. Only energy was negative for the quarter as OPEC struggles to increase global oil prices. Expect volatility to remain present amidst tensions in the Middle East. The broadening of the rally and positive economic data are giving investors hope for an upcoming U.S. presidential election. History shows that bear markets in bonds are more like koala bears than grizzly bears, and given the average intra-year decline is just 3.5% per year versus the average decline in equities of 14.2%. Further, following bad years of performance, bonds tend to deliver strong returns, which is proving to be the case here in the Q3 of 2024 and should continue as rates come down. Despite average intra-year declines of 3.5%, bonds have been positive for 43 of the last 48 years, going back to 1976. Now, the Fed's preferred gauge for inflation is the Core Personal Consumption Expenditure, or PCE, price index, which the Fed is trying to lower to 2%. Even though consumption has remained resilient and above the Fed's 2% target, the Fed hopes to stay ahead of the recession by reducing rates by 50 basis points, doubling the expected reduction of 25 basis points. According to the Bureau of Economic Analysis, the Core Personal Consumption Expenditures Price Index increased just a seasonally adjusted 0.1% for the month. It was up 2.6% from a year ago, the latter number rising by 0.1 percentage points from the May level. The unemployment rate decreased from 4.2 in August to 4.1 in September. Most economists remain optimistic about the U.S. economy's near-term outlook and believe it is normalizing after a hot stretch last year. After a sluggish July and August, economists now feel that the economy is back on track towards achieving a soft landing. Real gross domestic product, GDP, increased at an annual rate of 1.6% in the first quarter of 2024, according to the third estimate. The increase in the second quarter primarily reflected increases in consumer spending, inventory investments, and business investment. Imports, which are subtracted from the calculation of GDP, increased. Nonetheless, the economy could lose momentum in Q4 of 24 as high prices and elevated interest rates sap domestic demand. This will provide slower momentum heading into 2025, which may constrain growth that year to just 1.7%, despite the expenditures of more robust quarterly annualized growth as the year progresses. The Federal Reserve lowered interest rates by 50 basis points, easing monetary policy for the first time in 4 years due to progress on the Fed's dual mandate. The Fed's decision to ease monetary policy will likely support growth and stabilize a slower labor market. 2 additional rate cuts will be likely in 2024, and we expect them to continue into 2025. Fed rates influence the cost of borrowing, including mortgages, credit cards, and business loans. Now, let's discuss the 4 key investment ideas for the rest of 2024. We're going to talk about each of these in a little bit more depth as we go through the video. Artificial intelligence is now a part of the long-term technology opportunity set. As AI transforms industries like semiconductors, cybersecurity, and healthcare, these are areas to watch. Stock picking is crucial in this area of wide dispersion between high-quality and low-quality growth companies. The AI marketplace is set to soar to more than $187 billion in 2023, indicating an 800% gain from today. AI holds the potential to streamline the protracted process of introducing new products to the market. For example, enabling researchers to identify promising drug candidates swiftly. This efficiency saves time and enhances the quality of products available to consumers. Focus on companies with good fundamentals, strong balance sheets, cash flows, business models, and strong management teams, as well as profit trajectories. We're expecting broad market participation in equities in 2024. Given the current interest rate environment, we prefer large cap versus mid cap and small cap companies. When interest rates reached record lows in 2021, large cap companies effectively extended the terms of their debt. Now approximately 90% of the large cap debt consists of fixed rate loans, with over 50% maturing beyond 20. An election supercycle will unfold in 2024 against elevated geopolitical risk and economic competition between nations. Rising geopolitical tensions could trigger more trade restrictions across the globe in further economic fragmentation. Companies benefiting from the reshoring of critical supply chains and increased investment in national security may present compelling investment opportunities. With rising geopolitical tensions and logistical delays during COVID, companies are diversifying their supply chains. International valuations are attractive, except in China, but active management is essential. Although U.S. equities, both styles, tended to outperform, the new dynamic is forming, given the more recent outperformance of international. Even as yield curves decline, they are among the highest observed in the U.S. in the last decade. This underscores the fixed income market's potential to deliver substantial income streams, mitigate yield volatility, and offer relatively attractive valuations. Looking ahead through the year end, consider this. Now is the time to extend durations. Bonds have delivered nearly double the annual return of cash over the last 40 years. Bonds have historically outperformed cash and low duration during rate-cutting cycles. Reinvestment risk is real. Let's talk about 6 evergreen investing principles for the upcoming election. Here are the 6 evergreen investing principles. 1. It pays to own stocks. 2. Pullbacks and even corrections can be expected. 3. Keep a long-term view to protect your long-term goals. 4. Non-recession bear markets are typically shallower and far more rare. 5. Market timers miss out. 6. Don't let your feelings about the economy torpedo your investment strategy. When it comes to funding investment objectives, history has shown that there are no better alternatives to equities in providing better potential for capital growth over the long haul. The market has overcome temporary setbacks and continues to march ahead. This is a great visual, encourages zooming out and understanding that U.S. equities have survived every setback, no matter how dire the situation may have looked at the time. If you're invested in the stock market, you're likely pursuing investment objectives that extend well past this year. Even note that it's paid to own stocks most years. The S&P has had an annual return of less than a negative 10% only 12 times dating back to 26. That's almost 100 years ago. The S&P has generated a positive return 74% of the years since 26, and about 60% of the returns have been 10% or greater. About 38% of the years result in returns of 20% or more. Even the best returning years for the markets have at least one inter-year decline, with an average inter-year decline of a negative 14%. This chart shows inter-year stock market declines. They're the red dot in the number, and the market's return for the entire year, the gray bar. It clarifies that the market can recover from inter-year drops and finish the year in positive territory, encouraging investors to stay the course when markets do get choppy. For example, in 2020, the market at one point was down 34%, but ended the year up 16%. In 2009, the market was down 28% at one point in time, ended up 23%. In addition, annual returns were positive in 33 of the last 44 years. Again, the longer the time horizon, the stronger your opportunity for higher returns. For example, over a 5-year rolling period, a 60-40 stock bond portfolio could return anywhere from a plus 1% a year to a plus 20% per year. Stocks and bonds can be much more volatile during short periods, such as a year. Many investors report worrying about the impact of the 2024 election on their portfolios, but I believe these fears are likely overblown. Across the entire ballot, there's not enough historical evidence to support investors voting with their portfolios rather than their personal and political beliefs. However, the policies implemented by the elected officials are important, especially with the next administration responsible for addressing the expiring provisions of the Tax Cuts and Jobs Act. Every election year of a president since 1944 has resulted in stocks posting gains for that year, regardless of who won. The average annual return of the U.S. equities in those presidential years has been 16%. For example, time your IRA and retirement plan contributions. If you see the market experiencing a pullback, consider making these contributions at a possible market low. Consider Roth conversions during market pullbacks, as it provides a tax break on top of the Roth IRA's many excellent benefits. Don't forget a backdoor Roth conversion as well. Consider your cash flow. During volatile markets, consider cutting back on expenses and confirming your liquidity is adequate and your emergency fund is in place. If you are considering retiring, consider delaying that retirement until the markets stabilize. Drawing down on your investment portfolio during times of volatility may slow the growth of your assets. Consider investing that cash that's been sitting on the sidelines. If you have extra cash, 24 may be a time to consider dollar cost averaging into markets as yields continue to decline. Consider rebalancing your portfolio, whether selling overvalued, less desirable positions or rotating investments you previously hesitated to consider, such as cyclical stocks. Also, review your hedging strategies to make sure they still make sense. With tech posting substantial market gains, be careful to diversify your portfolio and minimize capital gains wherever possible. However, avoid running afoul of the wash sale rule when selling equities. Maybe consider getting more aggressive with your asset allocation strategy if you have a long-term time horizon and the proper temperament to handle market volatility. Review your gifting strategies in light of market volatility. Some strategies make more sense when assets are depressed, such as GRATs and private annuities. Looking ahead through the end of the year, Invest cash sitting on the sidelines for better long-term gains. Valuation-focused investing is critical now. It's not just all tech all the time. Don't forget about those international equities, as they are doing well too. Stay focused on the long term. Thank you for joining me today. Navigating volatile markets requires a strong plan tailored to your unique situation. If your current advisor isn't offering this level of insight and strategy, it might be time for a change. Schedule a meeting with me to ensure your investments are aligned with your financial goals. And let's get you on the path to long-term success. And a quick thanks to everybody who helped provide us information on this presentation.